I want the MACD to be confirming. So if I get a break up higher, and this is positive, that is not confirming. Okay, if I get a breakdown lower here, again, with this current reading, it is not confirming. Breakout higher has to be positive, breakdown lower has to be negative. Again, breakout higher through resistance, the MACD has to be positive, and a breakdown lower through support, the MACD has to be negative. And again, this is that MACD traditional. I like this histogram reading a lot. That's my preference. It's a signal line histogram, and what it does is it gives me a visual indicator of short-term momentum trading. So you have to find a market that is not trending, which is what this 15-minute Aussie is not trending right now. It was, right? It was in a downtrend, but now it's not. So you have to find a market that's not trending. And then you have to wait for the market to reveal its next trend or phase or cycle by essentially showing you that it's able to break down or break out from the pattern that it's currently stuck within. Right now we don't have that pattern, okay? But the main step is recognizing that flat 3 o'clock angle and then looking for some support or resistance. I probably have a pretty good justification for some support here, okay? But I really don't have any great resistance. But I can wait, you know, that's the point. You know, we want to wait for those perfect opportunities where we have all the pieces in place. We don't want to force trades. In fact, gang, let me tell you something. I feel that great traders look for reasons not to take the trade. Bad traders look for reasons to take a trade. Big difference there. Okay? Here's a pretty good idea of maybe a triangle pattern on the Kiwi. Okay? So here's a triangle pattern, not the greatest I've ever seen, but it'll do for our example. Flat market, flat 3 o'clock wave. Let me go ahead and put this into market memory because I want you guys to build those good habits. So this is a 15-minute chart. I've basically got about 4 or 5 days here, so I'm good. I'm golden as far as my look back. Clock angle reading, flat 3 o'clock. Absolutely. And then I have my triangle pattern, a little short term, but for our purposes, for an example, it'll do. What I'm waiting for now, okay, are either prices to break out higher through the, there we go, through the ceiling, or break down lower through the floor. This is the downtrend line resistance, uptrend line support, ceiling, floor. Right now, my MACD is pointing towards confirming an upward surge, a break higher. But again, the indicator is only meant to confirm price breaking. We don't have a price break, so I got to sit and wait. Okay? So if I get that price breaking up higher through resistance, I'm in business. If we get prices weakening, breaking down through a floor, again, I'm in business. All right? All right, so basically what we want to make sure that we're doing is confirming that we're going to see the price break out higher. What happens in these situations with these very small histogram bars is that they can dip into neutral really, really easily. Okay? They can dip into neutral super easy. And if that happens, or they dip into kind of, you know, when I say neutral, you guys have probably seen it. And if you haven't, there are times when the bars are very, very short, or they might even be going positive, negative. That's not a good reading at all, is it? That's not the kind of reading we want to confirm short-term momentum, either heading higher or lower. So when I see these bars reducing in height, I'm very wary about placing any kind of proactive or parking any kind of stop order. It's when they're plotting nice and tall, either, you know, tall to the downside or tall to the upside, that I feel a little bit more comfortable placing those types of orders. Okay, that's a little nuance there for those of you that are kind of comfortable with the MACD, but they're just food for thought. Okay, so again, the main difference is starting with that assessment of whether the market's trending or not trending. Okay, there is no confirmation tool for the swing. The wave itself is the confirmation, by the way, for those of you that are wondering what's the equivalent of the MACD for swings. There really isn't. I do have a setup that I utilize the wave and the CCI with, and I'll talk about that on Saturday, but today, gang, what the whole point was to introduce this concept of making sure that you're basically distinguishing between trending and non-trending setups. Okay, so it's just kind of an intro, a conversation. Hopefully, we're going to, start to discuss this more often, either at the blog. We're going to have a daily blog at the IBFX site where I'll be writing lessons and instructional articles, and eventually we're even going to be doing morning and evening commentary. It's called the Daily Trading Edge. So hopefully you can join me there. It's going to be a new blog over at ibfx.com. So certainly we can keep the discussion going there. Okay. Of course, we have our big Saturday webinar where we'll be putting all these tools together. All right. So you can check back at the website for more information about that. Okay. And again, the whole idea behind our discussion today was making sure we're considering our strategies and our indicators within the context of the market cycle. That's the biggie here. If there's anything that I'm hoping to impart upon you, it's that. Making sure that whatever strategy you're using, consider whether it's a trending or non-trending strategy. And I looked at two of my bread and butter setups here, which is playing the corrections, which is, as you can see, really the more common scenario right now with all the trends we've been seeing, okay, versus waiting for those momentum. We haven't had a lot of momentum setups lately. The market has not been getting quiet, staying quiet, and creating that. It's mostly been a lot of swing trading. But that's just what the market's mood is right now. Okay. All right. So again, I'm giving you guys kind of the outline sketches of this. There's a whole lot more than what obviously we did not get into risk management, and a lot of other things. But you got to think about the constraints of time we have here with a 60-minute webinar, which I consistently have been stretching to 85 and 75, 85, 90 minutes, and I appreciate your patience. But obviously, there's only so much we can cover in the time allotted. But again, that's where we have our big 4-hour talk on Saturday. All right, everybody. So let me give you guys my email address one more time. It's raghee.horner@ibfx.com. I am slowly chipping away at the emails. I've been getting consistently anywhere from 25 to 50 emails per session, and we're into our 3rd session, so that gives you an idea of what my inbox is looking at like right now. So again, I appreciate your patience, and I hope that, if anything, you guys have now begun to start to consider your current strategies and current indicators and how they work within this concept of market cycles and this concept of using those trending indicators and trending setups for when the market cycle is 12 to 2 o'clock or 4 to 6 o'clock on the wave, when to set up triangles and so forth when the market is basically moving sideways, and how to recognize those. Gang, thank you so much for your time, and I'll see you in our next session.